Stephan and Kevin O'Leary had an interesting convo recently. A lot of good things were said, but certain things were left out. So if you want to know what was left out, stick till the end of today's video. Welcome back, folks, to another edition of the Also Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic because, guess what? I'm doing marvelous. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation around a discussion that Kevin O'Leary had recently with Stephan. And we're putting a thumbnail of the video we're talking about here on the screen. It says Kevin O'Leary reacts to my $10 million investment. And the link also is there. But before we get into the nitty-gritty, folks, this is not about criticizing Stephan or Kevin O'Leary. As a matter of fact, we love both creators. As a matter of we are great fans of Stephan, and we love Kevin O'Leary for his knowledge, for his ability. This is one of our role models. This guy is so personable and so knowledgeable. Great guy. But we just have to add our 2 cents to the conversation here. So on the screen right now, you are seeing that we put what Stephan showed to Kevin. The first thing he showed the property he had in 2012, and he said, I had no credit history and no credit card, so no bank wanted to lend me money, and that was a cash deal. And Kevin's response was, get a credit card if you're a millennial. I'm just trying to simplify things here, but what he said was, in essence, get a credit card if you are a millennial, put a $1,000 limit on it, spend $200 and pay it every month. And for the second property, Kevin had no real comment. So we're putting the things on the screen here. And for the third property, Kevin said there was an inherent risk of concentration. Your entire net worth is in real estate. And for the fourth property, basically what Kevin said was you brought leverage into the portfolio. We're showing all the screenshots on the screen right now so you can see. Here is what I have to say. Number one, when it comes to credit card, where basically Kevin is saying that you want to get a credit card if you're a millennial, that's kind of cool. But I want to tell you, please educate yourself first. Get some financial education. A credit card is not a toy. So even if you want to get it, even if he says you have to get it, if you don't have the education to understand how to use a credit card, then it's not really worth it. So please, first, if you are a millennial or you are somebody who is a little older but has no knowledge of how credit card works, please educate yourself. You can go to an evening course, or you can go on the internet online. There are free online courses that talk about credit cards. So just don't go there and get a card without having some minimum education around it. And also, you can also start with having a secured card. Get a secured credit card. That way the money is coming out of your bank account, so you're not tempted to spend more. That way you can build credit very gradually and safely. Another comment I want to make here is that obviously I agree with Kevin O'Leary that Stephan is a great investor, that's for sure. But based on the $10 million portfolio we see here, the concentration is too high. Well, I will talk about later on about his concentration, but having so much money put into real estate is just it's great. It may be great for him, but it may not work for a lot of investors out there. And on the fourth property, when he brought leverage into the portfolio, when people talk about leverage in finance, it means debt. It means you are borrowing to buy assets. So, and we believe it's great that if you want to pursue a real estate investment strategy, to bring leverage into your portfolio, that we agree. Don't try to do it by yourself. You want to be able to use the power of leverage to increase your investments, of course, in a responsible way. Let's move on to property number 5. So you can see it on the screen. The thing here is that so Kevin says something like, if stuff happens, the market takes a downturn and value goes down, you still owe. So you got to start being sensitive to how much debt you're bringing to your world. And I love, and this is such a great comment. And I love Kevin O'Leary's has a great metaphor that was told to him, a great story that was told to him by a real estate developer in New York, the proteins versus pasta story, where he's saying that, never extend yourself too much so you can still pay the mortgage on the building that were leveraged using cash from debt-free buildings. So, and we had an interesting conversation and an interesting comment from Graham. Graham said, "I don't raise rents." The question is it a good thing? Personally, and our team has thought about this, we don't believe is a great move, but Graham is certainly in a position, liquidity-wise, where he can afford not to raise rents on customers. Because if you're not raising rents, it means that you're not keeping up with inflation, and that means that it's at the income, the cash inflows do not have the same value in actual dollar. So actual dollar value is not there. So we are seeing here is so Graham and Kevin were talking about the fact that Graham's has 2.9 million total debt across all buildings, and Kevin made a very good point where he talked about if you get wiped out in your 40s, you are toast. And he was giving the story of some of his friends who were wiped out in their 40s because they didn't respect debt. So you need to be disciplined. You need to be buying assets that have income. What I'm trying to say here is that, of course, you have to use debt to pursue your objectives, especially when it comes to real estate. But please respect that. Be disciplined. Buy assets that have income, what I call good debt. A mortgage is a good debt. A car loan is not really a good debt. Why? Because the car's value is not appreciating. The car is not getting value, whereas the house is. So Kevin was talking about his friends. They were buying boats back in the days, cars, watches, and divorces. I don't know if that divorce is an asset, but so the point is, he was talking about the fact that those guys, those friends of his, they just loved their lifestyle back in the days, but they went back to zero. Now we're looking at Graham's cash investments. So you can see here that he has some cash invested in CD. That's fantastic. We'll love that. And property 6, we're seeing here on the screen. And Kevin said something that was very interesting to us. He said that you should not leave more than 20% of your net worth in one asset class. And that's a great point here. Folks, this is very important. When we talk about asset classes, what are we talking about here? We're talking about things like stocks, bonds, ETFs. ETF stands for exchange traded funds, mutual funds, real estate. You also have commodities like gold, silver, copper, coffee. The point here is that if you want to have an optimal investment portfolio, you don't want to have more than one fifth of your portfolio in one asset class. This obviously is not the case with Graham Stephan, but again, Graham is a very smart investor. He has been doing this for several years now, so his case might be different. But for you out there who's listening, who is a newbie, or who is who is an experienced investor but wants to hear more insights here, don't do this. Don't put all your cash in real estate. And we'll show you later on the percentage of exposure that Graham has vis-a-vis the real estate market. Let's move on. So we move on to property number 7. So on the screen right now. So Graham actually showed this to Kevin, and Kevin said that the discipline is that every 90 days you trim back anything over 5% and put it back into something that you decided to go into. Now, he said no sector more than 20%, no stock more than 5%. And Graham made a very interesting comment, and this really struck the whole team at the Sweaty Kiwi show. He said, "I don't want to pay taxes, so I don't want to sell." In other words, he basically wants to leave the stocks in the portfolio, even if he is not diversified, or investors call that being concentrated, having a concentrated position. In other words, when you analyze your portfolio, you notice that one asset class or one asset comprises or draws 20-30% of the entire portfolio's value. So this is really wrong. I mean, in our view, of course, we're not giving any advice to Grams here. He doesn't need our advice. I mean, he's a great guy already. But we're just talking to the millions of investors out there. Please don't have that concentration. Do not overexpose yourself, because it's not about paying taxes. First of all, there's nothing wrong with paying taxes. Capital gains taxes are not that high. You're talking about 10, 15%. Income taxes are around 10, 15, or 20%. So there's nothing wrong with that per se. A lot of investors have this notion that you have to dodge taxes, so fiscal optimization is just part of the portfolio management strategy. I understand that, but there's nothing wrong with it per se. So if you are so exposed, God forbid, if you get a market correction, you'll get hit with a massive loss. So, and we agree with the advice that Kevin gave to Graham when he said it's a huge mistake you're making. And he made another point that we found fantastic. Kevin, we love you. This is just great. Kevin said, never use margins in stock, and that is so true. And I'm speaking here from experience. I got whapped out a few years ago because I used margin. And I've done research about this myself, so I know this is definitely true. Never use margins. If you cannot afford it, just wait till you can afford it. Trying to build a cash portion of your portfolio as opposed to relying on quote-unquote margin money that the brokerage is offering you. So never do that. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? If you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell. We drop this kind of shows every single day, so you'll be notified in real time whenever we drop a new show. Also, like this content, comment, and share. So we're having a conversation here around a debate, a little discussion that Stephan and Kevin O'Leary had a few days or weeks ago about Graham's $10 million portfolio. And a lot of stuff was said, a lot of interesting stuff. And we love both guys. And we love Kevin for his, Kevin is one of our role models. That's for sure. And we love that was an interesting debate, but there are a few things that were left out. And our job here is to sort of, quote unquote, set the record straight. So the millions of newbie investors out there can understand how the game is played. Now, on the screen right now, we're showing you the Stephan's stock portfolio. So he showed this to Kevin. And so we have here that your cash is 30%. He said cash is 30% of my entire portfolio. We'll show him later on that number is inflated. And Kevin said that cash in his portfolio is way higher. It's also because he's much older. The thing I want to say here is that you have to understand that when Kevin O'Leary said to Stephan, you are extremely disciplined. You put cash in assets that you thought might appreciate. The only negative thing that he thinks is that you got too much real estate. Now let's talk. When Graham asked him what score would he give him, Kevin said, I'm giving you 8 as a real estate operator, real estate developer, investor, if you will. But as a portfolio manager, he's giving him a 7 or 6.5. The thing here is that and we have 3 things to say. We agree with Kevin. First, Graham is over concentrated in one asset, that's for sure. But we're not giving Graham an 8, even as an operator, or 7. Graham, we love you, but we will give you a 6.5 because of that overexposure. It is, and we'll show you why we said that. So we will, even though we love you, we'll probably give you 6.5 because you're just, it's too much. The concentration is too much there. The second thing here is that when Kevin says cash is 30% of the entire portfolio, and Kevin said that's too much. It's not too much. It's really not too much. The thing here is that actually it was Kevin who said that. Kevin said that cash is 30% of his entire portfolio. And what we want to say here is that it's not too much for someone like Kevin, because Kevin is a little older. He's in his 60s. So if you are in that age bracket, or you are in your late 40s, your risk tolerance changes. So you have to shift. You need to be sitting on a lot of liquidity because stuff can happen. So you want to get away from quote unquote volatile securities such as stocks, and you want to switch to maybe fixed income securities, just bonds and cash equivalents. So this is pretty good in terms of someone who is in his 50s or 60s, or you can even be younger. But if you have a risk tolerance level that's lower, in other words, if you're a conservative, a risk averse investor, you can go ahead and also have a higher level of cash in your portfolio. What's the point here? The point here is that as we are analyzing Graham Stephan's portfolio, we see that we see two things. So he has a little cash on hand, and he has an over concentration in one sector, real estate. So let me make a few points here before we close. So we actually ran the numbers with what Graham posted in his video, and we're showing you on the screen right now. We have done a screenshot. We have ran the numbers, and we are showing you where we have a recap of Graham Stephan's portfolio, and you can see that he has 60% of his portfolio is exposed to the real estate market, folks. 60%. Now, I'm very sure that Graham Stephan has other portfolios. He only chose to show this one, or maybe this is the only one. He'll probably tell us if he thinks so. But the point here is that, Graham, we love you, but this is too much. You are in your late 20s. This is still okay. You can take a little bit of risk, but not that much. Why? If stuff happens, you are toast, my friend. You are toast. So you can see that he has 60% of his money invested in real estate. And then you have, for investments, you have 19%. And for cash, you have 21%. So remember, before he told Kevin that 30% of his 30% of his portfolio was in cash. When we ran the numbers, we saw it was way lower. So 20%. For us, that's pretty healthy. 20% is healthy. Anytime for someone in his 20s, if you have cash invested, you have cash and cash equivalents of 10 to 20%, that's healthy. But the real estate is not healthy. One thing we will tell you, Graham, rather, if you are watching this show, please, in the next few months and weeks and years, you want to switch things around. You want to reduce your exposure to the real estate market to maybe 35%. You want to increase your exposure to the stock market to maybe 30%. You want to get some bonds that will diversify your portfolio further. So you are trying to maybe get bonds around 10% or 15%. So you have 35% real estate, 35% stocks and equivalent. So equities in general. So that's 70%. You get some bonds for 20%. That's 90%. And then you keep 10% on cash in cash. That will be a greatly optimized portfolio for someone in your age bracket. Let's have a general conversation here. Folks, if you are listening to me right now and you're not as sophisticated as Graham Stephan, or you don't have the financial wherewithal, the financial base, the money that he has, because Graham is a multimillionaire and he has said it himself, and based on his portfolio, again, we are definitely sure this is not his only portfolio. He has others. So the advice we're giving you here, as if you're a newbie somewhere there listening to this, is that whenever you want to get into investments, please get financial education. I mean, money education. I'm not asking you to get a PhD in finance here. No, I'm asking you to understand what is debt. You know, as I was saying earlier, get a secured credit card at first, not a regular credit card. That way the money is coming from your checking account. So you know those things, that you know that you are protecting yourself from making a big mistake in terms of financial management when you're in your 20s or when you're new to the market. Now, Kevin O'Leary has said he doesn't like debt. It's okay. He's debt averse, what I call debt averse, but you shouldn't be, especially if you are in your 20s, 30s, even 40s. That's number one about debts. I also want to talk about asset allocation. Folks, I'm recapping here. I want you to really pay attention. When it comes to asset allocation, please don't go the route that Graham has chosen unless you are very sure of what you're doing. Instead, what I'm telling you to do is to invest in a broad basket of securities, including cash, stocks, bonds, real estate, and alternatives. The alternatives it can be anything that you found that is not publicly traded. You have to think about your risk tolerance. And the reason why I keep talking about Graham is overexposed to the real estate market is because this harks back to the whole concept of risk tolerance. The reason why Graham can sleep at night is because his risk tolerance is very high. He's okay with taking on that much risk. But you have to know your own risk tolerance. Are you risk averse or risk taker? And that conversation depends on a lot of things. Your age, what is your financial goal? What are you looking for? What is your time horizon? So if you are in your 20s, if you are in your 20s like Graham, you have time, right? If we have a market correction, now it might take 10 years or 5 years or whatever, but you have time. By the time the market gets back into positive territory, you'll probably be 30 or 40, but you can still rebound. But this is not an opportunity that someone in his or her 50s or 60s can afford to take. And one thing you also have to think about when it comes to risk tolerance is, would you need the cash soon? Obviously, Stephan has a healthy balance sheet. So if stuff happens, if the market gets corrected, if there's a market correction in the real estate market in California, he has time to rebound. So he has cash. So you have to think about liquidity. Do you have cash on hand? Do you have savings? Do you have emergency fund? That's very important. We have an entire show covering emergency funds, or AKA rainy day accounts. You got to think about that. You also have to think about rebalancing your portfolio every now and then. Rebalancing means that you are making sure that the percentages that you chose in terms of asset allocation are complied with. So if you went with let's say what I call 60 30 10, for instance, that means 60% of your portfolio invested in stocks, 30% in bonds, and 10% in cash. You have to constantly monitor the percentage in your portfolio to make sure that as prices moves, as you have prices moving up and down, you need to rebalance the portfolio to always be in sync with your percentages. For example, let's say you have 60 30 10, and after 2 months or 3 months, we have a rally in the market. So your stock, the underlying stocks in your portfolio have grown. So the value has increased to be now 70% of your portfolio. What you have to do is you need to sell those overvalued stocks to bring back the cash percentage to 60%. That's what people mean by portfolio rebalancing. All right, folks. I will see you next time. Thank you so much for listening to this conversation. We want to say thank you to Graham, Stephan, and Kevin O'Leary for initiating this conversation. This was a great conversation. You guys are fantastic. We love you, and thanks for listening. I will see you next time. But until then, remember, stay marvelous.